good, y'all? Welcome back to the channel. It's been a minute since I made a video, and I do apologize for that. I've just been very busy getting pulled in a bunch of different directions, but I'm back now, and I will be making these videos more consistently. All I'm going to be doing today, though, is just updating you on the changes I've made to what I'm holding in my portfolio, and also kind of giving you a little bit of insight as to where my mind is and a bit of a different approach that I'm taking to investing and how I invest, because I think that that approach is going to help me and better benefit me in the long term. Okay. So, as you know, I'm an income investor. I invest for income. I don't think there's any problem with investing for growth. I'm going to be doing that as well. But as of right now, my main focus is getting $100,000 into this dividend portfolio and increasing my income. If you was working a job making 50, $60,000 and your boss came to you and offered you a 10, 15, 20% raise, you're gonna take it. If you was making $75,000 at a job and you got another offer to pay you 100,000, you're gonna take it. It's the same concept with dividend investing. I want to be able to give myself a raise. So with dividend investing, I can take my money that I make, give myself a raise. I don't have to ask anybody, beg anybody, work harder, go back to school, get a certificate. I don't have to do any of that. I just have to take money, invest it in the right companies, and give myself a raise. That's why I like income investing. Some people have different opinions about it. They think you should just do growth only, or they think you should wait till you get older to invest in dividend. That's fine. There's nothing wrong with that. I don't, knock anybody's anything, but I like to invest in dividend paying stocks. So, like I said, I've changed up some my mentality to investing. Really, the two biggest things that I've changed up is this. SCHD, if you're not familiar with it, it's the Schwab US Dividend Equity ETF. In my opinion, this is the best dividend income producer over the long term. So what I'm going to be doing is using SCHD as the baseline for all of my investments. So if a company that I'm looking at does not meet these two preliminary requirements, well, one of these two preliminary requirements, I don't look at the company no matter what. If the company does not have a higher dividend CAGR than SCHD, meaning that if they don't grow their dividend year over year higher than SCHD grows its dividend, I'm not investing my money in it. Or if it does not have a higher starting dividend yield than SCHD, I'm not investing my money in it. If a company at least has one of those two, meets one of those two criteria, a higher dividend yield than SCHD and a higher dividend CAGR than SCHD, then I'll look into it and do a little bit more research on it. If it piques my interest, I'll invest in it. That's what's going to be my two just preliminary eliminators for companies that I look at. So with that being said, Dow, which is the company that my first company, one of the first companies I invested in, as you can see, I'm down on Dow, big 30%. I still believe I bought it undervalued. I'm fairly certain this that the price is gonna rise back above that $40 mark. When it does that, and I see a decent little profit, I'm gonna sell out of Dow, because Dow, the problem with Dow is that while it has a higher starting dividend yield than SCHD, right, 9.77, almost 10% dividend yield, mine is a little bit lower. Mine is like at a little over 7%. I'm not averaging down into this. I'm done putting money in Dow. All I'm gonna do is I turn the drip off of Dow. I'm gonna use the dividends that Dow pays me and put them into companies that I think are better than Dow. So, but once this company rises above that $40 mark, I'm gonna sell and move that whole 4,400, or well, I'm gonna move my whole position over to a new stock, a new company. The thing about Dow though is that while, like I said, the dividend yield is higher than SCHD's, their dividend CAGR is actually zero. This company Dow is a spinoff. It's been around for about 5, 6 years. They have not raised their dividend not once. It's been $70 since they spun the company off, and that's what's going to be an automatic eliminator for me. So like I said before, stuff that's going to benefit your investing journey in the long run is making sure that the dividend CAGR of a company you invest in is higher than inflation. So if we look right here and we just type in yeah, it's already in there. US inflation rate, 2.3%. So if the dividend CAGR of the stock I'm investing in is not higher than inflation, then I'm not investing in it. I don't care what the if it's not higher than inflation, I just don't want to invest in it. I just don't it doesn't pay a high enough yield. Now, if it was paying me 100% yield, 70, 50, 60% yield, that'd be different. But that's this company doesn't if it doesn't pay, if the CAGR is not above inflation, I'm just going to steer away from companies like that. So although it checks one of those boxes for having a higher starting dividend yield than SCHD, the fact that the dividend CAGR is zero, this makes it an automatic eliminator. I'm young in my investing journey. Every investor has a that one company that's like, dang, I could have put it in something else. It was funny enough at the time that I was debating about putting money in Dow, I also saw MO. I like Altria Group. I saw MO back when the dividend yield was like dang there over 8%, and the stock price was like 40, yeah, about $43. I started looking at it about July, but it was around that 43, $45 dollar mark. So if I would have put that whole 4,400 into Altria Group, I'd be sitting a lot prettier right now. But you live and you learn. You're gonna make mistakes over your investing journey while you're while you're still getting used to everything. You're still building your knowledge base. Still just you're just young in it, so you're gonna make certain mistakes. I don't think that was a mistake. It just as I got smarter, I'm a little bit more sophisticated with it. It just wouldn't have if me if I was in my current mindset at the time that I was buying Dow, I would not have bought Dow, just to put it like that. So it's as you evolve, you're going to see certain things that you just won't invest in, or that your current self won't invest in, and Dow is one of those things for me. But yeah, that's pretty much that on that. I got some different positions in here though. So you see, I got T Row, I got EPD, I got C and Q. I like T Row. Now this channel right here is just a just an update. I'm just updating you on my journey to getting 100,000. So it's just me giving financial updates on my investing journey. I'm not really going to get too much into the financials of these companies. I do research the financials and go over them for myself to make sure that's what I want to invest in, but I'm not going to make this channel me sitting here reading off, annual reports and things like that. You can kind of do that on your own. I will tell you what attracted me to these companies though, starting with T Row, which was one of my new positions. T Row, very simple reasons that attracted me to it. This company has no debt. So I don't know any company that's ever went bankrupt that didn't have any debt. I think Peter Lynch said that, and I tend to agree with him, especially on that point he made. So T Row does not have any debt. They have a very simple business model. These are the two things that attract me to T Row: no debt and a very simple business model. All they do is charge fees on their assets under management. So they are a money manager. They have mutual funds. They have 401ks, different kind of retirement accounts. People put their money into their funds. They invest those funds for people. They invest them for institutions. They invest them for cities, whatever. They invest money. So all T Row does is just charge a fee on their assets under management. The reason why T Row stock has been dropping, and luckily for me, I was able to get in there at the lows. So I was able to get in there and get some shares at some pretty low prices, specifically these around that $81 mark. But the reason why their stock has been dropping, if you look at go right here, T Row price, backing out to the 1 year. So as you see here, going back to May 2024, that stock price has been dropping, little pumps here and there, but it's been largely just dropping. And the reason why it's been dropping, this is, I think, the Liberation Day it dropped even. I think that's when I bought my that's when I bought them was around that Liberation Day. My first like 15 shares I got was around when Trump announced the tariffs in there. You had that little mini crash, if that's what you want to call it. But the reason why their stock price has been going down is because they're having outflows. So just like uh just like how, well, I'll put it like this, they have outflows with their assets under management. If they're charging fees on assets under management and their assets under management drop, then the amount of money that they're going to make from their fees drop. So it's kind of like, you're getting interest on $100. 10% interest on $100 is $10. Well, 10% interest on $90 is $9. 10% interest on $80 is $8. And the more that assets under management drops, the lower the amount of revenue for that company. So that's the same thing with T Rowe. As their assets under management drop, then the amount of fees and the amount of money that they make from those fees drops as well. The reason why it's dropping is because ETFs have become very popular because of their low fee structure. Mutual funds have pretty high fees in relation to ETFs, which are uh, passively managed. So ETFs, they just track an index, so they're mainly passively managed, while mutual funds are actively managed, so they charge that higher fee. But a lot of people are, they're getting better results or almost the exact same results investing in ETFs with lower fees than they are with actively managed mutual funds, which has led to some net outflows of T Rowe's assets under management. That's why that price has been coming down. So all I'm gonna do is just watch that chart of watch that T Rowe chart. I gotta log in again. So like I said, all I'm gonna do is just be watching that T Rowe chart and just keep watching as the price, just keeps on kind of trickling down. I'm just gonna be just adding here and there, just kind of dollar cost averaging into T Rowe. Like I said, I like T Rowe at any price below $100. Okay, that's what I like T Rowe at. Now another company that I like is C&Q. C&Q, remember, like I said, SCHD, I need that dividend CAGR. Any company that I invest in, the CAGR, the dividend CAGR, or the starting dividend yield needs to be higher than SCHD. With C&Q, both of those things are higher than SCHD. So that was those two things being higher than SCHD really piqued my interest and helped me take a look into this company. C&Q, Canadian Natural Resource, they are the one of the largest oil and gas producers in Canada. I believe they're the third largest oil producer in Canada, fifth largest natural gas producer in Canada. So they're a very large blue chip company, $65 billion market cap. So very very large player in the energy sector in North America. What really piqued my interest, like I said, about this company is their dividend CAGR. They have 3 and 5 year dividend CAGRs above 20%. I think their 10-year dividend CAGR is like between 15 to 18%. Their 1 year dividend CAGR 15%, but they have dividend CAGRs 20+%, 15+%, which is higher than SCHD's. I think SCHD their dividend CAGR is between 10 to 12%. But so it beats SCHD on the CAGR and also beats them on the starting dividend yield. SCHD has a starting yield of 4%. C&Q has a starting yield of 5.5%. So that's what I liked about it. C&Q also has some of the largest oil sands assets in Canada. So I believe that they're the second largest. They hold the second largest amount of oil sands assets in Canada. Oil sands have long life to them, so they're I believe one of their oil sands sites, they have like 33 or 30 plus years of oil they can pull out of that oil sands basin. So this company has a very good balance sheet. I think that they're poised to be a major player in energy production, not just in Canada but worldwide. Canada has LNG Canada, where they want to. What really attracted me to this company was their natural gas. They're fifth largest natural gas producer in Canada. Canada has this LNG Canada initiative where they want to build export facilities and send natural gas to other developing countries that need it. So that's what really attracted me to that. Less the oil portion, more the natural gas production portion of C&Q. That's what attracted me to this company. Now another company that I'm also a new company I'm holding is EPD. Unlike or another thing before I get off topic, when it comes to C&Q, you have to just be aware of this. Since C&Q is a Canadian company, there is a tax withholding on the dividends that you're going to be paid. So I think the normal tax withholding rate is 25%, meaning that if they pay you $1,000 in dividends one month, they're going to withhold 25% tax to pay to the country of Canada because it's a Canadian company. If they pay you 1,000, you're only going to get $750 of that because they have a 25% tax withholding. Now, luckily for me, if you don't know, I live in the US. If you can't tell, I the US and Canada have a tax treaty. So the taxes that will be withheld from me as a US citizen is only going to be 15%. So if they pay me $1,000 in dividends one month, I'll get $850. Unlike somebody in another country who may not have that same tax treaty or may not have a tax treaty that's as favorable as the US and Canada's is, you'll be getting like 750. Or maybe your country, I don't know, maybe if you're from England or something like that, maybe your tax treaty is even better than what the US and Canada has. You may have a 5% tax withholding or a 10% tax withholding. Just be aware of that. Anytime you're investing in a foreign company, you just want to be aware of the tax withholding. So just look at that amount so that way you're not, you know, taken aback when you expect to get 1,000, you only get 600, 700, 800, whatever that amount's going to be. Now moving on to EPD. While now C&Q is a oil and gas producer, EPD Enterprise Products Partner is an American midstream company. They do not produce oil and gas. I think some people are sometimes confused by that, but midstream companies do not produce oil and gas. They simply transport oil and gas in their pipelines or stored in their storage facilities. And that's exactly what EPD does. EPD is one of the largest midstream companies in North America. They have about 50,000 miles of pipeline. Of that amount of pipeline that they have, their natural gas pipelines are the third largest in North America. So that's what, like I said, what attracted me to C&Q was natural gas. I think natural gas is going to be a very important source of energy going forward in the future. Some people have different opinions about oil and natural gas and its long-term viability. In my opinion, oil and natural gas is going to be heavily used for the next 30, 35, 40, years plus. Now, I'm not saying these are forever holds, but for the next foreseeable 2, 3, 4 decades, I think that these are going to be, at least in my opinion, considered a hold. So that's why I like EPD. $63 billion market cap. They don't only have pipelines, they also have fractionation facilities and liquid storage capacity as well. So they can move oil and gas, they can store oil and gas. They also have over 25 years of consecutive dividend raises. So I also like that consistency with the income increases. They're raising that dividend. They've been raising it for the last over 2 decades now. So that's also a very positive thing for me. Now EPD has a dividend CAGR of about 5%, lower than SCHD's by like half. So keep that in mind. SCHD 10 to 12% CAGR, EPD about a 5% CAGR, but EPD starting yield is 6.8%, which is way higher, over 2% higher, almost 3% higher than EPD. So it checks off one of those boxes. That's what kind of triggered me to look at EPD. And when I looked at it, I kind of liked what I saw about the I didn't kind of like what I saw. I like what I saw about about this company and the financial position it's in and its long-term outlook for the future. One thing I also want to say about C&Q that really that I really liked about it was that it has they reduced their debt like $1.5 billion just in the first quarter of 2025. So from January to April, however long that first quarter is, they paid down $1.5 billion in debt, bringing down their total debt load to 15 billion, and they have plans to reduce it by several hundred million more this year. So that's also I really like that when companies have low or no debt loads. That really or at least they have a solid plan that they're executing on to pay down their debt load. That really attracts me to a company. Right, and that's pretty much it. Uh, like I said, my mentality around certain things have changed. That's why you don't see me invested in the cornerstone funds anymore. Like I said, you know, while Cornerstone does have a higher dividend than SCHD, they don't have their dividend. Well, I'm sorry, let me back up. Cornerstone does not have a dividend, they have a distribution. They're a closed-end fund. If you want to find out more about closed-end funds, I made my previous video talks about a general overview of closed-end funds. But the reason why I won't be investing in those Cornerstone funds for the foreseeable future is because of the distribution rate. So go here. So much like how I explained with T Rowe, how they have the price of their companies going down because their assets under management go down. When assets under management goes down, your revenue goes down because you're charging fees on those assets under management. If you have less stuff to charge a fee on, then you make less money. The same concept with Cornerstone is you look at a chart of Cornerstone of these funds, it just goes down and it goes down forever. And they don't really even have a business that they're running. They're just a fund that holds other funds and other companies. So when you look at their NAV, the NAV just goes down. Well, that distribution is that they're paying you is 20% of their NAV. So if their NAV goes down, that means that what they're paying you goes down. So really what they have is a negative CAGR. They have a negative distribution CAGR. If that's how you kind of want to think about it. Because if they're paying you 20% of their net asset value, we'll go right here. Let me go to the actual website. So CLM has a negative distribution CAGR because they're paying you out of their NAV. Well, you see here, if their price is going down, their NAV is going down as well. So they're paying you, but they're not growing their distribution. It's only going down. That's one of the reasons why I'm pulling away from those cornerstone funds. But that's pretty much it. I'm not against super high yielding things like on the video I'm going to make tomorrow when the market is open and I can do some buying. I'm going to be experimenting with those yield max funds. I figured that while my account is small, I might as well experiment and then just get some experience working certain strategies to increase my income. So as you know, those yield max funds, they decay a lot. Only difference between the yield max fund and the cornerstone fund is that cornerstone only pays you a 20% yield. That yield, that distribution is not enough to make up for its NAV erosion. Unlike yield max, their distribution is enough to make up for its NAV erosion. And don't misunderstand me, these my holding of these yield max funds, which I'm going to be buying tomorrow, is not long term at all. All I'm doing with these yield max funds is buying them, using the dividend that's paid to then push that extra income into blue chip companies. So right now you see that my income that I'm making off of about $6,400 is $444 a year. That's what I'm making off of a about $6,400 investment. So these yield max funds, they should boost that amount up quite significantly. So all I'm going to do is just keep on about 50% leverage. So I'm going to use my margin account, keep about 50% leverage on on the account. And with that, I'm going to use that arbitrage of the interest rate I have to pay versus the yield that Yield Max is paying me, the interest rate I have to pay to E-Trade, and the yield that Yield Max is paying me, and I'm going to push those into blue chip companies. There's two ways you can make your account safe from a margin call is to increase your assets owned that are not attached to leverage. So even though I'll have margin on my account, leverage on my account. When I take that money and push it into blue chip companies, that is money those are assets that have been bought with cash. So it increases my assets, my ratio from assets to debt widens in the account. You can do it that way, or you can just straight up pay down your margin that you use with the dividends you get or with your own cash from outside the account. I'm going to use the latter way for the for this little experiment. So we'll just see how it works out. I'll have more about that tomorrow. I'm going to make a video tomorrow, and I'll have more about go into a little bit more detail about that. I've already done that in this account with another company, Zim, but I've sold out of that position. But I'll explain all that on the next video. I'll be back on here tomorrow with another video. Thanks for tuning in. Thanks for watching the video. If you made it this far and you liked the video and you got something out of it, please like, share, and subscribe. Thank you. Have a good night.